Inflation is raging right now, everyone. I mean, have you seen the numbers? Have you seen these eye-popping figures? A 6.2% increase in inflation year over year through October 2021. That's the highest level America has experienced in over 3 decades. That's right, everyone. So the prices you're paying at the grocery store, at the gas pump, for rent, they're going up at 3-decade level highs. And that, of course, means that you and me are getting poorer because wages have not kept up with these inflationary pressures. What it also means is that the US housing market is going to continue appreciating because historically, home prices in America go up when inflation goes up. Right? Well, actually, no, that's wrong, everyone. America's history is littered with instances where inflationary pressures actually caused housing market crashes. And what I'm going to do in this video is give you the data on that history of inflation in the US housing market and link it to which markets, which cities today in the fall of 2021 are most at risk of an inflation-induced crash. And make no mistake, everyone, this is an extremely important video for you all to watch because there's so much misinformation out there about inflation's role in the US housing market. And I know a lot of you are starting to get scared that because of inflation, you better buy now because home prices are going to keep going up. So I'm making this video to set the record straight. We're going to be using historical data going back 40 years from Fannie Mae on housing markets across America. So you can actually see the real role that inflation plays in the US housing market and the cities here in the fall of 2021 that are most at risk of an inflation-induced crash. So without further ado, let's get into it, everyone. And we're going to get started on a graph looking at inflation levels in America going back over the last 40 years. This is data that comes from the Bureau of Labor Statistics. And we can see here that in October 2021, we have a 6.2% year-over-year increase in consumer price index, which measures the cost of goods and services that you and me buy in the economy. And this 6.2% increase is the highest level that we have seen since 1990. So that's right, everyone. The inflationary pressures we're seeing in America right now are quite legitimately historic, and that the last time we saw inflation this high, above 6%, was 1990. That was in a period that I call inflation era number 1, which lasted from 1987 to 1991. And it's really important that you remember these dates because we're going to reference them in just a couple minutes when we start comparing them to US housing market performance in the same period. We can see here that in the 1987, inflation rates were around low 4%. Then they went to the low 5% range in 1989, all the way to 6% in 1990. So this was just a big inflationary period as a whole. We also had a second inflationary period from 2004 to 2008, where rates of inflation ranged from 3% all the way up to 5.5%. And so while the rates of inflation in America today are high, we can see that we have had some periods in the last 30 years where we did have higher rates of extended inflation. So analyzing what happened to the US housing market in these periods can be very instructive about what to expect today in the fall of 2021, in the winter of 2022. What's going to happen to the US housing market with today's inflationary pressures? To answer that question, let's go back into history. And what we're looking at on this graph, everyone, I want you to pay special attention here because we're going to look at this graph over and over today for different markets across America, is comparing home price growth over the last 40 years, which is the yellow line, data from Fannie Mae, compared to the blue line, which is again the level of inflation. So this blue line is exactly the same as the graph we just looked at previously, but we're now comparing it to home price growth. And on this graph, we're looking at it for New York City, the New York City metro area. And what I want to point you all to is what happened to New York home prices in the 80s and then the early 90s. We can see that in the mid 80s in New York, home prices surged. They went all the way up to a peak of 25% increase year over year through 1986. However, after that, home prices in New York City proceeded to plunge all the way down in 1990 to negative 6% year over year. And over this kind of 5-year period in the early to mid 90s, prices in New York declined by about 10 to 15%. What's very interesting, if you noticed in that graph, everyone, is that those home prices in New York City declined during the period of high inflation. That's right. Let's look at this again. From 1986 all the way to 1990, we had a big inflationary increase in America that we just talked about. This was the last time inflation was this high, 1990. During this period of rising inflation, home prices in New York City collapsed. That's kind of funny, right? Because the mainstream narrative we're told about the US housing market is that higher levels of inflation lead to higher home prices. Yet here we have New York City in the late 80s, early 90s completely doing the opposite. Home prices crashed when inflation went up. Here's another example. Los Angeles behaved much the same way. We can see a big increase in home prices in LA all the way up to 1989, where prices were up 25% year over year, and then prices proceeded to collapse. If you're enjoying the data in this video so far and you can't wait to find out the 10 cities in America that are going to get crushed due to inflation, I'm just going to talk about them in a couple minutes, make sure you hit the like button. When you do that, it gets this video more exposure, and in turn, when that happens, I can actually produce more of this content going forward. So make sure to hit that like button, stick around. Just in a couple minutes, I'm going to show you 10 markets that inflation is going to crash. In one of the worst housing crashes in US history, from 1989 all the way to 1995 in LA, we had a big decline in home prices. This decline in home prices occurred just as inflation was getting red hot in America in 1990. Same situation in Boston. Boston had a big run up in prices in the mid 80s, then a big housing crash in the early 90s just as inflation was getting worse. So here we have New York City, Los Angeles, and Boston from the late 80s to the early 90s having big housing crashes, all while inflationary pressures in America were getting way worse. The same exact thing occurred in all of these cities in the second inflationary episode from 04 to 08. We see that inflation really picked up all the way through 08, yet prices crashed in New York. Same thing in LA, prices crashed as inflation got worse. Same thing in Boston, prices crashed in 08 as inflation got worse. So what's going on here, everyone? Why are some of the three most vibrant, largest housing markets in America defying the mainstream narrative in the 80s and 90s and the mid 2000s regarding inflation and home prices? Here's the important thing to understand, and this is going to dictate which housing markets today in the fall of 2021 are most at risk for an inflation-induced crash. I'm going to tell you those markets, the top 10, in 1 second. But before we get into that, you need to understand why New York, Boston, and LA always crash when inflation goes up, at least historically. And that's because, for this reason, everyone, when home prices go up a lot, above the level of inflation, when they go up by 15%, 20% in a year, that means they're already going up a lot. It makes that housing market more exposed to a crash when inflation occurs. Because when sustained inflation occurs, that typically means that interest rates go up. You can't really have a sustained level of long-term inflation without interest rates going up, because at some point, people who buy US Treasuries, US bonds are going to demand a higher rate of return on those bonds in a sustained inflationary environment. And when interest rates go up and mortgage rates go up, that tends to deflate any type of investment or asset that's speculative and relying on future growth. What this means is that when a housing market is already appreciating a lot above inflation, like New York was in the 80s, you can see the gap between the yellow and the blue lines was crazy. So New York's home prices were already way above inflation back then. New York's home prices were already way above inflation in the mid 2000s. Same with LA. Look at the big gap between home prices and inflation. Look at the big gap between home prices and inflation. When that occurs, it means the housing market and the local economy is speculative in nature. It means that there's people buying and selling homes based off future growth expectations. It means there's a lot of investors piling in. It means also that the local economy and many of the jobs in that local economy are based also off speculation. Companies and maybe new business startups that don't make any money but exist because easy financing and low interest rates are out there. However, when interest rates go up, that then can crash these housing markets and economies. And so what we need to do today in the fall of 2021 is find markets where prices have already gone way above inflation. And so now I'm going to run through 10 housing markets that I think are in massive bubbles right now in the fall of 2021 and that are actually going to suffer due to potential higher inflation rather than be helped by it. Austin, Texas. Take a look at the gap between home prices, the yellow line, and blue line inflation over the last 7 years. We can see that we're now on 7 years of home prices in Austin going up way above the levels of inflation through the second quarter of 2021, which is the most recent data available here through Fannie Mae. Austin has never had this stretch of outperformance above inflation in its local housing market, and that means that higher levels of inflation, higher levels of interest rates will likely bring home prices in Austin down, just as they did in the late 80s. We can see Austin actually had a big housing crash in the late 80s, one of the worst in US history, during a rising inflation, rising interest rate environment. Boise, Idaho. Just look at this ridiculous gap between home prices and inflation the last 5 to 6 years in Boise. This is completely uncharacteristic for Boise's history. We can see that actually historically, home prices going back to the 80s and 90s stayed pretty close to inflation in Boise. The one time before that they went way above in 06, they came crashing down. The same thing is going to happen again. Salt Lake City. Look at this crazy, crazy gap. Home prices way above inflation the last 5 to 6 years. The last time this happened, 06, prices came crashing down. Also take a look at the late 80s when Salt Lake had a dip during a rising inflation environment back then. Denver, one of the most epic gaps we can see here from 2016 to 2021. Home prices in Denver already way above inflation, already way above wages. More inflation, higher interest rates in Denver are going to mean home price declines. Something very similar happened in the late 80s where home prices in Denver went down during an increased period of inflation. Nashville, Tennessee, a historic level of home price growth over the last 5 years in Nashville. We're talking 8, 9, 10, 11% per year, 12% per year, well above inflation. This gap means that Nashville will be more unstable in a rising inflation interest rate environment. Atlanta, Georgia, housing market has really outperformed over the last 5 years in a way that it has never outperformed in its history. Atlanta home prices have never gone up this much above the rate of inflation. That means there's a lot of downside risk today. Phoenix, Arizona, everyone. A market that for 20 years from the early 80s to the early 2000s was pretty stable. We can then see 05, big run up in prices above inflation. 08, big crash below inflation, a rebound, and then basically over the last 5 years, home prices have continued to outperform, which means there's downside risk in an inflationary, higher interest rate environment. Dallas, Texas. Probably one of the sneakiest housing bubbles out there in America. Not a lot of people talk about Dallas being in a bubble, but when you take a look at home prices compared to inflation over the last 5 or 6 years, you can see that it most definitely is. Dallas also had a big housing crash. The last time this occurred in the early to mid 80s when prices went up above inflation, Dallas had a big crash in the late 80s, just as we were in a rising interest rate environment. Tampa, like Phoenix, was a market that for a long time, from 83 all the way up to 2000, was pretty stable. Then home prices became unhinged in 05 in Tampa. They came crashing down in 08. They rebounded and then since then have been well above the levels of inflation. And finally, Charlotte. Charlotte, which is in a personal record for home price growth. We can see that historically, Charlotte was actually pretty well linked to inflation through most of its history. But then over the last 6 years, boom, prices way, way up above the levels of inflation, which means that if inflation sustains itself, I think Charlotte's going to have a crash. Now, it's important to remember here, the analysis I'm doing in this video on those markets is purely on an inflation basis, right? Clearly, there's other things which will affect a local housing market, such as migration and job growth, and how many homes are being built will affect your housing market and the likelihood of a crash. But just purely from an inflation standpoint and what inflation means for a housing market, the 10 that I just showed you are not only unlikely to benefit from inflation and the higher interest rates that could come from it will crash these housing markets because prices are already too high. Prices are already well above inflation in these markets, and that means there's speculation going on. That means there's instability. That means a lot of these local economies also, in terms of the real jobs, the real businesses that are going there, they're benefiting from low interest rates. When interest rates go up, it's going to hurt these housing markets. However, not all housing markets in America are going to be hurt by inflation. In fact, I think many will be helped if we do enter a sustained inflation cycle. And I'm going to now show you some of the markets that I think are safe and that will actually benefit from inflation. One such market is Baltimore. And historically, we can actually see Baltimore is pretty volatile. There was a lot of ups and downs in home prices during inflation number 1. There was a big crash in home prices during inflation number 2. But actually, over the last 7 to 8 years in Baltimore, take a look at how close these yellow and blue lines are together. Home prices and inflation in Baltimore the last 7 to 8 years have basically kept track with each other. The same thing in a housing market like Albany, which once again, like Baltimore, had some volatility in its past, but now Albany over the last 7 or 8 years, home prices and inflation are pretty well linked together. Another market would be Little Rock, Arkansas, where we can actually see for pretty much the last 30 years in Little Rock, outside of this episode in inflation number 1, where home prices in Little Rock crashed during that inflation, we can see that since then, since 1991, inflation and home prices in Little Rock just basically move in lockstep with each other. And so this is the important thing to understand. The more that home prices move with inflation, the more that they're closely linked to inflation historically, like they've been in Baltimore and Albany and Little Rock, the more likely they will move with inflation and move in the direction of inflation in the future. Because those housing markets, Baltimore, Albany, Little Rock, many places in the Midwest, are more closely linked to the value of the US dollar, to the US inflationary environment. Meanwhile, in these aggressively appreciating Sunbelt markets, they're very speculative. They're not at all linked to the levels of inflation. And just like occurred in New York, Boston, and Los Angeles in the late 80s and early 90s and the mid 2000s, like we looked at earlier in this video, New York, Boston, and LA, they had big declines in home prices during those inflationary episodes. Many of the aggressively appreciating Sunbelt markets in America today are much the same and have the same downside risk. Now, I'm not necessarily convinced that long-term inflation is here to stay. Clearly, in the short term, we've had a big inflationary uptick over the last 6 months. Whether that means we're going to have another 2 years of high inflation, I'm not sure. The bond and treasury market certainly doesn't seem to think so. Treasury yields are still pretty low. The currency markets seem to still value the US dollar pretty highly. So I don't think it's clear that we're in for long-term inflation over 3 to 4 years like we saw in the late 80s, mid 2000s. But if we are, certain housing markets are going to benefit. These would be the lower growth, lower value markets where prices and inflation are more linked together. Other housing markets will suffer. These will be any housing market where prices are already way above inflation. These markets will take a nosedive in a rising inflation and interest rate environment. So I hope you all enjoyed this video. If you stuck with me through this, I know it was pretty technical. We looked at a lot of data here. If you did stick with me, if you really appreciate this content, make sure that you've hit the like button. If you already hit the like button, don't undo your previous like. But if you haven't yet, hit that like button because that gets these videos more exposure, allows me to produce more of this content going forward. Also, make sure that you're a subscriber. I come out with 3 of these data-driven videos per week. Now that the housing market's turning, now that a lot of crazy things are going on with inflation, you're going to want to watch these videos because I'm going to have the real-time data and the historical data to help inform you about how to make a better real estate investment and home buying decision. Additionally, make sure to join my channel as a sponsor member so you can gain access to the exclusive members-only newsletter, which you can see here on the screen. I come out with a monthly members-only newsletter and video. There's also an exclusive community board only for ReVenture channel members where I'll post data, I'll ask you questions, I'll poll you on the videos you think I should do. If you want to become a channel member, hit the join button below. The cost is only $5 a month. All my channel members love it so far, so I want you on board as well. Hit join below. There's also a link in the description so you can get access to these tremendous benefits. All right, everyone, until next time, this is Nick from ReVenture Consulting signing off.